Okay, let's go ahead and get started. Good morning and welcome to today's Tuesday morning market outlook. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the broader market. So before we get started, just our quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So the agenda for today, as usual, kicking off with the major equity indices. We are seeing signs for pullback here. So we'll keep an eye out for potential levels of support as we have been over the last few weeks. It's still a bull market, and you are looking at those areas of support as potential buying opportunities. From there, moving on to fixed income and commodities, I will also take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the broader market. We have a couple of subsectors of interest for you today, and we'll end today's webinar with some bullish and bearish market observations with one new idea. So starting off here with the S&P 500, just looking at the chat, I see Ernesto has asked what momentum indicators I use. So on TradingView, I use the 50-period CCI, which is the blue histogram. That measures longer-term momentum. It's really my favorite longer-term momentum indicator to use because I like to look at momentum at overbought and oversold conditions. And I would define an overbought condition at 200. So when the 50-period CCI reaches 200, that will be overbought, and that would indicate a high probability of a decline in momentum, which indicates either a retracement or a reversal lower. The other side of that is the oversold condition, which is at minus 200. So that's an extreme condition to the downside, which indicates potential for a retracement higher, like we saw here, or a reversal higher, which didn't quite reach minus 200, but we ended up getting that reversal anyway. And a great example of positive divergence as well, because momentum makes higher lows and price made a lower low, which is a bullish indicator. So that's also another way that I use the 50-period CCI is to identify divergence. However, you can use other indicators to do that. I just like to use a longer term indicator. And again, it's a 50-period 50. The red line is actually another momentum indicator, which is also the CCI, but it's a 6-period CCI. So it measures very short-term momentum. I like to look at it in terms of find not at overbought and oversold conditions, but what I like to do is really help me identify some areas of support. This isn't a great example. Well, actually, here would be a good example here on the weekly time frame, where we don't really see an overbought or oversold condition, but it does a good job in terms of trying to figure out where if a pullback is starting to reverse higher and continue with the overall trend. So we tend to see like the 6-period CCI doesn't really get to that overbought and stay in that overbought and oversold condition for too long, but it does help identify in a very quick way that the reversal or the retracement lower or higher is most likely over. The last indicator that I use, and I don't really use it that much, I just like to have it there in all honesty, it's called a TTM squeeze, TTM squeeze. It's these dots that you see in the middle of the momentum indicators. And I basically use an overlay to have them all in one section. But the TTM squeeze, it helps you identify when the stock is trending or consolidating. So when it's in green, it indicates it's trending. When it's in orange or red, it's consolidating. In my experience, when it turns green, usually you want to wait for a pull. If it indicates that there's a breakout, and usually you want to wait for a pullback before looking for that buying opportunity. So it's one of those indicators that I would advise trading based off of the signal. I think it warrants a more conservative approach because by the time it turns green, the stock has already made a big move either to the upside or the downside, but it does indicate that we could be out of the consolidation pattern, and now would be a good time to hop on to the trend. I don't use it that much. I prefer to use price action, but it does help in some cases. So I hope that explains it for you, Ernesto. Okay, so the S&P 500 forming a small double top here, just above 500 on the lower time frame. We do have some support here at around 480. That's the key level of support that I'm looking at. We can see it was a previous area of resistance and support in the past. Price set to open a little bit lower this morning, and we have some minor support at 490 as well that you could be looking at. I'd view that as more of an intraday support level. I think overall for the S&P 500, outlook here is bullish. Again, you're looking at these pullbacks as buying opportunities. And when I look at the macro picture, so with regards to interest rates, we know that March is most likely not going to be a cut, despite the fact that markets were pricing in a cut from the end of last year. But that still hasn't really stopped the momentum in equities, which tells us quite a lot. It tells us that the boom in AI is still providing a lot of optimism. And I would say it's probably, we've had a lot of booms in the past, especially like with Bitcoin or crypto and blockchain. But this AI boom does seem to warrant higher valuations and a bit more excitement for me. I think that it is the single most the biggest disruptor that I've ever seen since I started looking at trading or investing. And that's why I do think we could see, despite the fact that the Fed is a little bit more hawkish than before, we could still see price in the major equities continuing to rally because of this AI boom and the potential that it has for the future. Now, for the S&P, again, once again, taking a look at that price action, these areas of support are going to be potential buying opportunities, but you want to look at the price action at those levels. We know that, again, the Fed won't be cutting interest rates in March, but we still are expecting those interest rates later in the year, which is still going to be good news for equities across the board. The only thing is we saw consumer and producer prices last week still at elevated levels, which does give the green light for the Fed to keep interest rates level for a bit longer. And that they're going to use that, right? They definitely don't want to start cutting interest rates too early. So for that reason, for the S&P 500, still in a bullish structure. You really need to look at the weekly time frame to see how extended the bullish structure is. And if anything, we now need to, it's actually forming quite well here for a pullback opportunity because it is a little bit overextended. 50-period CCI very close to 200 as well. So I would consider that to be a little bit overbought here on the weekly time frame. So I wouldn't be surprised to see a pullback lower. Now for the NASDAQ 100, not quite forming that double top because the NASDAQ 100 is a lot more exposed to technology stocks, which have been pulling back a little bit more. However, we are seeing a rotation back into technology stocks. So we'll discuss that a little bit later. But for the NASDAQ 100, price set to open a little bit lower, but below 430, we have some support at around that 415 level. That's the major level that I'm looking at. No other support really that I can see. But in the last few days, it has been underperforming the S&P 500. I think that'll reverse, and we're going to start to see some outperformance once we see a rotation back into technology. Just keep in mind that the NASDAQ that technology, the sector itself was providing leadership for quite some time. It really was the reason behind such a big rally from November last year. So I don't necessarily think that because technology is underperforming slightly in the last 2 days, it means that we should be avoiding technology. If anything, it provides, once again, an opportunity to reinvest and look into technology, which should also bring the major indices higher. IWM, the Russell 2000 ETF, somewhat neutral price action in the last couple of sessions. We saw price respect and bounce higher from that 188 level, which was a 38.2 fib. That was quite a while ago. Initially tried to break out to the upside, failed, and now it is looking like it is breaking up to the upside. Starting to show signs of outperformance in the last 2 days relative to the S&P and the NASDAQ 100, but still below the 206 level, the previous swing area here, and also still below 210. Now, 210 is my short-term upside target, which is a 23.6 fib level. And I do think that with the price action that we're seeing in the last few days, and the fact that we are still in a risk-on environment despite the prolonged interest rates, I think that IWM has a great opportunity here to not only reach 210, but also get back to all-time high territory quite quickly, especially once we start to get a little bit more dovish news. So that could be in the form of an inflation number, that could be in the form of a jobs report. Once we start to see some momentum with regards to inflation coming below phase expectations, that's when I will look at IWM and small caps for their outperformance. Like we saw, in the early days of the pandemic, a recovery period where interest rates were lower and small caps were outperforming the broader markets. All right, TLT, the Treasury Bond ETF. So yields are continuing to remain elevated. We know that's not going to be the case for the rest of the year. But TLT actually broke below that 94, 93 level, is sitting at around 92 here. I wouldn't say there's that much more room to the downside, in all honesty. I think that we're looking for more price action at current levels or slightly lower if it does decline a little bit lower for an ideal risk to reward bullish opportunity. But again, very much dependent on yields, which is very much dependent on the Fed and what they say, which is very much dependent on inflation and jobs numbers and all the macro stuff. So for TLT, I think a bit of patience is going to be required before we see that move up higher, but I do expect to see a revisit back to that $100 level once we get the green light in terms of the Fed cutting interest rates. Now, the US dollar, as yields have pretty much stayed neutral, the US dollar is actually declining. So it's still above that 104 level, which is key because it still maintains a bullish structure if you look at it for 2024. But there isn't that much momentum. We are seeing momentum starting to die down. I think we could see a lot more consolidation at this level. And on the upside here at 105.50, that's also a major resistance zone. I don't really see the US dollar breaking above this level. Also, when you look at the other central banks that are in charge of the currencies that the US dollar is compared to for this index, we are seeing that they are still in a very hawkish frame of mind. In other words, they're not really looking to cut interest rates anytime soon. I'm talking about Bank of England, the ECB, the European Central Bank. Bank of England is looking to potentially start cutting interest rates. There are a bit more dovish signs there, but also BOJ. All these central banks that have major currencies, they're not really looking to cut interest rates just yet. So the relative performance is always going to favor them in the short term, which is why the US dollar, I don't really see that much upside. The only reason it's remaining elevated above 104 is because yields are remaining elevated. Gold. So gold is actually breaking below here, this 187 support level. We saw it break down, coming back to retest it and actually set to open a little bit higher. But once again, I'm going to say what I said the last few weeks. We've seen very neutral price action, supported 184, resistance at around that 190 to 193, major resistance zone. This is a multi-year level of resistance. Price is not able to break above it. Momentum has also died down. It's currently negative on the daily time frame. So the risk to reward, should we see a continuation of this rally, is to the downside. And that's what I'll be looking for. I'll be waiting for rallies to look to potentially sell call credit spreads that are bearish, and that could take advantage of the neutral to bearish conditions should we see gold have experienced a short-term rally. Now, oil has managed to rally once again. What I like about this chart is it's not as choppy as it was once before, but it is still range bound. We can see that 78 is a major resistance zone. The price is struggling to break above, even today showing some bearish price action. So the risk reward still favors the downside. And you can have a very tight risk to reward because if, let's say, for example, if oil breaks above and closes above 78, that's when you know it's been invalidated. Maybe 80, I wouldn't say 78, maybe 80. We're seeing, price rejecting that $80 level as well. So anywhere within this range. But the risk reward does favor the downside. But support at 70 is holding very, very strong. All right, so sector rotation. We have 7 sectors in the improving and leading categories, and we have 4 in the lagging and weakening. So the leading category is we have industrials actually performing quite well, improving in terms of relative strength against the broader market. So it is in the leading category and should join be joined soon by healthcare, it looks like. Energy did see a bit of a bounce. No surprise there, with oil actually bouncing higher in the last few days. And we also have utilities just about in the improving category, and real estate as well in the improving category. Weakening category, we have technology and communications. I think technology is now at a stage where it's going to start improving in terms of momentum and relative strength. I was looking at a lot of the semiconductor names, especially, and we are seeing signs of in the short term, in the very short term, the last 3 days, of outperformance relative to the broader market. And that has to do with the AI optimism and the AI boom. So keep an eye on technology. It hasn't been in the leading category for quite some time, so it could be due a revisit back to that category. Financials and staples, both in the lagging category. Staples very much underperforming, losing out on relative strength and momentum. And again, that speaks to the fact that we are still in a risk-on environment. And financials with a bit of a rebound. I actually have a subsector of interest that can hopefully benefit from this rebound here in financials. So our first subsector is lithium, the lithium and battery technology ETF, LIT. I've been waiting for some form of confirmation here for LIT because we've seen a very strong decline for a very long period of time. But in my opinion, well, first of all, we had an oversold condition. We have the 50-period CCI below -200 when price was at around 46, around there. And now when price has made a new lower low, momentum has made a higher low, and that is positive divergence, which is, as you saw in the previous S&P chart, I think, a very bullish indicator. And given the fact, again, that we are in a risk-on environment, we could very well see LIT experiencing a strong rebound. So price did manage to break above 42 the last trading session. Set to open a little bit lower this morning, but in terms of the longer term, I think the risk reward does favor the upside. We have 46, 47 as a resistance zone to the upside to be looking at, and if it breaks out above that, the $50 level is the next area of interest. So LIT, I think now is a good time to be looking at these long positions here. Unless you're more conservative, you want to wait for additional bullish price action, that would also make sense as well. Okay, KRE, the regional banking ETF. KRE has overall been on an uptrend since November. It has experienced quite a big pullback, especially with earnings season this year. We saw price decline from around 53, 54 all the way down to 46, but finding a very strong level of support, as you can see, and showing signs of wanting to push higher. Initially failed with the reversal, but once again, we're seeing price just shy of 50. I think if it can break and close above this previous green candle, that would indicate a good risk reward long opportunity here for KRE, especially with financials starting to gain a bit more momentum against the broader markets. Okay, some ideas. This is a new idea for today. It's actually Intel. So Intel, it's not an actionable idea just yet. What I'm waiting for is actually a break below that level where price is rejecting around 45. A break and close above that level provides a good entry point and for a continuation higher. Again, technology is experiencing an inward rotation or should shortly be experiencing an inward rotation. We had a bad earnings announcement which saw price gap down, but there is still a lot of optimism with regards to the semiconductor space. And I think this gap down does provide a good opportunity for a long once we get confirmation of a breakout above 45. The other entry point that I see is actually here at 42. If we can get a decline to 42, that would actually be the best case scenario for a bullish entry. It gives a much better risk to reward. Stops below 42. And if we get any bullish confirmation there or bullish price action, a very good risk to reward bullish entry point targeting either 45 or even 50. Lowe's is a home builder name. This is a name that we've been bullish on now for quite some time. Last week, I suggested taking partial profits. And so far, price is continuing higher, a bit of a gap down this morning, but still very much in line with our thesis and approaching that 232, 235 area. So once it gets there, that's when you'd probably want to close the entire position. But for now, home builder is still performing very well. So no other updates for Lowe's in terms of that. NEM, so Newmont, that was an idea from last week. This is a gold miner. And what we saw was usually gold miners have a high correlation to gold prices. Hasn't been the case due to valuation concerns here for Newmont. But Newmont is now undervalued, in my opinion, well below its 5-year price to earnings average. And I think it's due for a reversal higher, especially with gold maintaining somewhat of a neutral level at these elevated conditions. Now, Newmont does have earnings coming out, so you may want to keep an eye out on that, but it could be a good earnings play given the fact that it's sold off and is showing some bullish price action ahead of earnings. But ideally, if earnings wasn't in the equation, a breakout above 34 would be an additional confirmation. But we were bullish on this last week, and it's pretty much at break even right now. Okay, Sea Limited. Sea Limited was another name that we were bullish on. Taking partial profits last week. We saw a breakout and rally to 44, slight pullback back to this previous swing level at 42, and a continuation higher with price set to open even higher this morning. So it is pretty much approaching that full take profit level. I'll be looking at 47, 48 as a full take profits. But even if you took profits in the last session where price was rejecting this 46 area, that would also be a good idea, in my opinion, because of that rejection. But with price set to open a little bit higher this morning, I'd let the trade run if you still have it on, maybe to get to 47 or 48. And this was a earnings play, a bullish earnings play from 2 weeks ago. So it actually worked out very well for us. Prices below $80 a share and rallied all the way at its peak to 160, which is insane. Huge rally there. And since then, it has pulled back slightly, consolidating above 120. Now, in my opinion, is a great time to be taking profits on this and really moving on to the next trade. It was a great earnings trade that worked out well for us, but you don't want to get too greedy here. At the end of the day, the stock has just doubled in the space of a couple of days. So you don't want to push your luck too much here, in my opinion, despite the excitement around this name. And with that, that is all I have for you today. Big thank you to all that joined me, and I will see you next week, Tuesday, for another market outlook. I hope you all have a great trading week. Goodbye, everyone.